Welcome to the Mayar Capital quarterly live questions and answers session. Thank you very much for your patience in joining us today. We had a few tech gremlins, but I'm really pleased to let you know we've overcome those. So thank you so much for bearing with us. For those of you who have not yet met, my name is Lee Overall-Gibbons. I'm the head of sales and client relations at Mayar. So really good to meet you. More importantly, I'm joined today by Aziz Al-Nain, who is the portfolio manager and MD of Mayar Capital, and Aubrey Brocklebank, who is a partner, deputy portfolio manager, and head of investment research at Mayar Capital. So welcome, gents.
Thank you.
Thank you so much, audience, for your questions so far. We've had a whole host come through. I'm going to be absolutely delighted to ask Aziz and Aubrey your questions on your behalf. There is a question and answers section on your screen. So if you have a particular question that comes up whilst we're having the live Q&A today, please put that question through. It will come through anonymously. No one will see it except for me. And I will be really happy to ask the team on your behalf. So we expect today's session to last approximately 30 minutes, and it's very interactive. It's all for you, so please do push your questions through. So without any further ado, Aubrey, Aziz, I think we should kick off. And as I said, we've had a fair few questions in. So first question from our audience is, the global economy has felt pressure, and the World Bank has revised down its forecasts for the world economic growth. As small investors, what is your advice to minimize the impact of the new risk?
Well, I think there are several things to keep in mind. The first thing is, in most cases, either a small investor or a big investor should really care what the World Bank's forecasts for the economy this year is going to be. And that's the case for several reasons. The first reason is that they're almost certainly going to be wrong. They revise these things all the time. And one of the things that I want to say, it's a best kept secret, but I don't know that it's even a secret. GDP numbers and economic indicator numbers get revised after the fact all the time, 3 months later, 6 months later. So not only are we bad at forecasting these numbers ahead of time, we're bad at even measuring them at the time. And so the question that then becomes important is, why does it matter what the economy is going to do? And I think if you're investing for your retirement, or if you're investing for some future event, then frankly, what happens in the next 6 months or the next year really has no impact on your decisions, or shouldn't have any impact on your decisions. You need to really be thinking about the long term and working towards that. And I think that's the only horizon that really matters. And I think if you're trying to invest in the short term, then you should not be investing in anything that does have any economic exposure. So you shouldn't be investing in equities, for example, if you need the money in the next 6 months or 1 year or 2 years for that matter to pay for a life event or something like that. So my view is, over periods that do matter, you really shouldn't be investing in something that's exposed to the economic outcome. And for periods longer than that, then the forecast over the short term doesn't really matter. And in the end, the forecasts and the actual numbers are going to be wrong anyways. Aubrey?
Yeah, I mean, I sort of wonder about the phrase this new risk. I don't think any of these risks are new. In fact, these are risks that we have been mitigating against for the past 2 years.
Yeah.
You know, our portfolio has been positioned because we have seen these risks and we do not want to be exposed to them. You know, in part, that is, I guess, why we have underperformed, because we haven't sort of taken the risk of being, you know, massively long America and long these, you know, really exciting tech names. So, you know, how would I say you mitigate it? Well, do what we do. You know, invest in great companies that are going to do really well over the long run, as Aziz is saying. and don't get tempted by the sort of short-termism.
Yeah, no, that's a good point actually that I failed to mention. Thank you, Aubrey. I think the other thing to keep in mind is, well, CNBC and whatever your favorite news channel are going to make you believe. The behavior of the market in any one day or any one month might seem like it's reacting or predicting something. It is complete noise. It's only after the fact that we really know why something's up or down in any one day. We've been in so many cases where we'd look at something and the stock is up 5% and we'll find a reason why it's up in the news. And then later in the day, we look at it again and it's down 3%. And now we're like, oh, what happened? And then we come up with a plausible explanation after the fact. And I think it's in the short term, it's all noise.
That's really helpful. Thank you, gents, for that insight. Hopefully that's answered the person's question. And like you say, very much that medium to long-term view and not getting tempted by those sexy stocks. Sort of looking on the next question, focusing here on the US. So what's your outlook for the job market in the US this year and the next year, given how interest rates remain high and manufacturing production are declining along with the real estate activity?
Well, that's certainly completely outside our circle of competence. So we can't tell you what's going to happen. Frankly, I don't know that anyone knows what's going to happen, given it's such a dynamic environment today with kind of one day we're talking about tariffs, the other day on the merits of why you should use sugar instead of corn syrup in Coca-Cola, all within the remit of the President of the United States. But who knows? It seems that I would say real estate has been having issues in the US for a few years right now. And obviously a lot of it has to do with high rates. And that's not a prediction, that's just saying what's out there. And we've also seen the job market really start to slack off the past 2 months especially, and even some of the numbers that have come up, for example, the last job report where it did show growth, almost all of that growth was in state government. So actually the private sector is not hiring, and companies are slashing costs, trying to deal with the uncertainty. And it's not that it's necessarily a bad environment. I think companies are always able to deal with a bad economic environment. I think the challenge for a lot of US companies these days is that there is so much uncertainty about everything. And I think for them, there's nothing worse for a business than not knowing what your costs of input are going to be. And if you're a retailer or a manufacturer and you need to import something and then you need to sell it in 1, 2, 3, 6 months, not knowing your costs is a really challenging place to be. And I don't know if that's going to change. We've seen this kind of environment now for a few months, and it seems that the US government is continuing with their policy of trying to negotiate in kind of reality TV fashion. I don't know. I would not be. I envy the job of a purchasing manager in any US companies, a US company these days. I don't know, Aubrey, if you have anything to add.
No, I don't think there's anything I can add to that.
Aziz, bearing in mind those points that you've mentioned, what does that mean also then for the broader global economy? And I suppose in that probably kicks into sort of costings, tariffs, and the implications there.
Well, I've always taken the view that if you own a business that is of high quality and run by managers that are capable and aligned with you, it's really their job to figure things out, and they're really good at it. And so this is one of the beauties of owning businesses as opposed to owning a bond or something like that, is that you've basically hired the best CEOs in the world, and they're working on your behalf as an owner. And when there's a challenging environment, you don't have to figure it out. You've got people who are specialized in whatever area they work, and they're among the best in the world at that, and they can figure out the implications for the business. We don't even have to know what they're going to do, because frankly, they're much better at running their businesses than we would. And kind of this is kind of one of the things that I've kind of, I guess, reached as a conclusion very early on, and thinking as a business owner as opposed to someone who's trying to pick stocks that go up next week. And in an environment like this, that's probably going to continue to be uncertain. We're very lucky to have one of the best management teams across our portfolio who are capable and aligned with us, because that's a key part of our investment process. And I'm confident that they've got the strength of the business, the strength of the balance sheet, the strength of the management team. I actually think that uncertainty, and I wrote about this in this my latest letter, is probably this uncertainty and volatility actually gives companies like the ones we own an advantage over others, and they can actually, at the end of it, become better businesses and better companies, capture market share whenever possible over their weaker competitors. Aubrey?
Yeah, I mean, the economy has certainly run hot for the last few years. I struggle to see how it continues to run as hot, but I'm not going to call, I'm not going to make any calls. I thought I had made a great call, Q1, at the beginning of Q1, and it looked like that was playing out, but the market is very unpredictable in the short term. So as you say, it's just great to have great CEOs and to know that by investing in great businesses run by great people, it's going to be okay.
A guy that I know once said, whenever you make a call that the bubble is about to pop and there's going to be a bear market, God looks down on the market and say, let there be a bull market.
Yes.
So the markets are certainly good at humbling people who make predictions.
Very true. Well, unless you make enough of them.
Yeah, broken clock.
Very wise words, certainly. Now, I'm going to put a big caveat in front of this. So next question is about emerging market debt and the debt market. And of course, we are equity specialists. So I think we need to put that caveat in mind, that's the hat that we come to this party. So what is your take on emerging debt market in the GCC region?
Like you said, not an area of expertise. I think one of the benefits of GCC debt is that you tend to not have currency risk be as big of a factor for non-US dollar denominated debt that's issued in local currency. But we also know that some of the GCC countries are weaker than others in terms of, and that's not a secret. You can see their ratings by debt agencies. They're weaker than others. And in an environment where energy prices are low, some of these countries, the thing with credit in general, whether bonds or otherwise, is unlike equity, when you're wrong, things go only in one way. With equities, you can be wrong about a prediction. And sometimes you make more money because your error was in under appreciating how well something's going to go. The problem with debt is that surprises are always to the downside. And it's one of the things I don't like about debt as an investor. But yeah, I think that's as much as I can say because it's not an area of expertise for us.
No, quite understand that. Sorry, Aubrey.
No, I was just going to say you've covered the only thing I could have said on that. Other than if you need to know about it, I'd find an expert because we're equity guys.
Absolutely. So looking now towards macro market outlook, are there any new themes or sectors that you're looking at the moment that are particularly exciting for the fund?
Well, we're not generally big on themes, but we can maybe things that we like. I mean, we talked last time, I think, about why we're excited about Europe and reindustrialization in Europe. And That's certainly one big thing that we believe is a multi-year thing. Obviously, we've been bearish on US tech to our detriment the past 3 years. So that's another theme that we've gotten wrong. So whatever we predict, I don't know whether or not you should believe our predictions. Eventually, we'll be right, which is what everyone who's wrong says. I don't know. Aubrey?
Yeah, and as you say, we've discussed Europe a lot, and I think still believe in that. Just the borrowing power and the necessity. One of my former bosses once said to me that don't think about what you want to happen or what you think might happen. Think about what has to happen. Think about just what absolutely has to happen, and then trade on that. And I think that's quite a good sort of mentality because, I think when you look at Europe, they have to reindustrialize. We have to spend more on infrastructure. More has to be spent on, becoming more independent from America. That's just become so plain. It has to happen. The only question is how long does it take? What else? But I think aside from that, we're seeing opportunities come up in sort of, lots of different areas, and it's because, as we've discussed before, when all the sort of exciting tech stocks sort of suck capital out of the rest of the market, it leaves sort of vacuums of capital in all sorts of different places. Whether it's niche chemical companies or or parts of the tech market that are overlooked or boring parts of the tech market. There are parts which the sort of opportunities are coming up in lots of different places. So I'm quite excited about that.
Well, I think the other thing to keep in mind, and I know we've talked about this, is that the S&P hides the fact, the S&P 500 hides the fact that for a big part of the world in many sectors, so many geographies and many sectors, have been in recession for the past 2 to 3 years. And some of them are just starting to emerge from that. And that's the thing that kind of people look at the headline numbers for the S&P or the MSCI and you see it kind of all-time high, but that's just purely driven by one sector in the US, which is tech. And the rest of the US has been struggling for years to some degree, or not all of it, but many sectors. And if you look across the US to Europe particularly, there's just so many sectors that have been in recession for several years now. And so you almost have this asynchronous cycle between what tech and S&P is and what kind of the real economy is doing, especially in Europe. And I think that shift is going to start. This is what we started to see the past few months. And I think it's a couple of years to go, and where you're seeing a recovery, even as US tech stocks and otherwise start to slow down.
Thank you for that insight. Sort of looking now towards this last quarter, and the fund has had positive performance. What's been the key drivers to that?
I think one of the things that we talked about earlier this year was we've always prided ourselves in having a portfolio do well in times when markets don't do well. And if you look at any period since inception where the market has gone down by 10% or more, in all periods, with the exception of one, our portfolio outperformed, in some cases by a lot, like 5, 6, 10%. And that's what happened in April when we saw kind of the Liberation Day triggered a market sell-off. Now, we've given up a big part of that outperformance, but we've always been happy to be in a position where if markets go up, we keep up with markets. That's a great place to be. And if the market crashes, we protect our downside. We like that combination or that return profile for our strategy. And that's what we saw this year. So it was kind of what happened in March and April and into early May is kind of reconfirming to us, at least, and I hope to many of our investors, that the strategy is working in the way that it should work, which is something that, like I said, the one time it didn't happen was late 2022. And I think that got us thinking a lot about what we did wrong at the time and what we could have done differently. And that kind of got us to think deeply about mistakes that we've done and how we can learn from them. But I think it's encouraging to see that once again, that the strategy is working exactly the way we intended it to be, which reconfirms our conviction in what's going to happen in the next few years, and also reconfirms our conviction that over long periods of time, the strategy will work in the way we want it to work, which is that return profile that I just talked about. And when markets do well, we do well. When markets do badly, we don't do as badly. And that's got a nice place for us to be. And I think we're in an environment where we think we're going to continue to see volatility. That is really a great strategy to have. And Aubrey, if you've got anything to add.
I don't think I can add anything to that.
That's really helpful, Aziz. I'm mindful that we don't have the crystal ball, and you've alluded to the fact of where we've come from and your optimism, certainly for the future. What's your outlook? What would your outlook be for the fund? Obviously, without putting numbers, or we don't have that crystal ball. What would your outlook be for the fund, and why should people be looking at it now?
Yeah, I think that's a great question. And definitely, I'm not going to put numbers in place, but I do think that we're going to continue to have volatility. I mean, what we're seeing now is just a manifestation of the underlying forces economically, politically, geopolitically that we're seeing in the world. And I think we're going to continue to see more of that. I think as an investor, I like to be invested in a strategy that not only survives these kinds of conditions, but thrives in them. And I think we've shown time and time again, like I said, with the exception of one period, that every time the market goes down 10%, we do well. And I think it's because our companies of such high quality, both in terms of their businesses and the competitive advantages of the businesses, the management teams that they have, the balance sheets that they have, that of course they're going to do well in that type of environment. Of course they're going to win when things are not going so well. And that's, we've talked, again, we've used the analogy many times, like of the tortoise and the hare. This is really where we want to be. Like, and we will grow in the same way grass grows, as opposed to anything exciting. We like boring. We like to be boring. We like to compound over long periods of time without taking excessive risk. And we've shown this time and time again. And I know we haven't shown good results the past 2.5 years or so. But I think once again, this quarter, we've shown what happens when our strategy really shines. And I think we're just going to have more and more of that in the next few years. And I think we will have periods like the past 2 to 3 years. I mean, I've been doing this for 25 years. It's happened twice for me in the past 25 years. And I'm sure it's going to happen again in the next 25 years of my investing career. So I think this is kind of a normal part of the process. It tests you as an investor, and you should go and double check and triple check everything that you do. But it is a feature of what we do. And for better or for worse, you're going to have periods like that, and you're going to have the opposite, which is periods where you do well when others don't. And I mean, it's partly why this thing works. There are periods where you as a value investor, you get tested, and I think you get eventually the reward for sticking to your knitting. Aubrey?
Yeah, I mean, look, I mean, I'm feeling a bit pessimistic today because I'm feeling unwell. So I'm just going to say I think we're just going to do pretty well. I mean, there's going to be volatility, as you say, but that's our opportunity. That is our opportunity, and over the long run, it should play out.
Mm-hmm.
I suppose with those points in mind, and keeping in the forefront of my mind the quarterly letter that we issue out to clients. Is there a particular stock that would sort of showcase the mindset of the fund and that opportunity and that reliability, that you're looking at this over that medium to long term viewpoint, and you're looking at companies which can continually deliver despite what's going on in the marketplace? Is there any particular company that comes to mind?
Well, I mean, partially as some of the stuff we talk about in the quarterly letter, and we talked last quarter about kind of Johnson Service Group and an extremely boring business that puts out excellent numbers. That just the power of that compounding over long periods of time that really shines. We also talked, I think, in the past about some of our longer term holdings that we like we still own Unilever and we still own Johnson & Johnson, and people look at them and say, well, why do you own this? And then go look back at their performance over time. They tend to do well, but they particularly help us in periods where there's a lot of volatility, and that's an underappreciated feature in a portfolio. We like having these things that kind of anchor the portfolio and give us protection on the downside, even if they may not be as exciting in terms of the upside. But on the flip side of it, there are businesses that we own that, at least by our standards, are very exciting, like Ashtead, that continue to grow and do extremely well, and will continue to do extremely well because they've just got a tremendous competitive advantage. And we've got all these businesses that are under people's radar.
We find Ashtead really exciting, but I don't think the rest of the world finds equipment leasing to be really exciting.
Well, I'll tell you, what? Every time I walk, I was literally at Boots this morning. I walked into Boots, and at the Boots by Angel, the air conditioning isn't working very well, and it's a hot day, and they had this huge fan cooling the room, and it was leased from Ashtead, and it got me super excited. I mean, it's just
no, I know, and I do the same, and I point it out to my daughter, and she just goes, "Oh, Dad."
Yeah, but I mean, I guess the other thing that we briefly mentioned Croda in the latest quarterly letter, so it's the latest purchase, and again, Boots happens to be a customer of Croda, specialty chemical company, and so is most of the brands that you know. That's L'Oreal and Estee Lauder and Unilever. A lot of these companies would use ingredients from Croda. But maybe, Aubrey, you could tell us this. I know you're not feeling great today, and we've finally got you out of bed to join this meeting. But if you could just give us kind of a minute on Croda, maybe just tell people about it.
So, as you say, they make the active ingredients for a lot of these products that you like. So if you want sort of some of the best anti-aging cream is the Boots stuff. That is, really top stuff. Now I remember sort of the guys at Croda were telling me, no, this is the one. They use the most of our active ingredients. But they don't just make it; they develop it with the client. So they'll sit down with Boots and say, look, what is it you're after? And Boots say, okay, well, we want this cream, but we need this sort of smell because we've had this feedback. And they go, okay, well, we can alter the smell. We can get they get it so that it's just right for the customer, and they spend a long time working together. So they're absolutely essential to Boots and to L'Oreal because it's an active ingredient, and it's a tiny part of their costs. So that's something we really like about it, and because it's sort of all consumer goods, pretty much, or at least a lot of the business, it's a very sort of reliable business. But the thing is, they do have different units. So there is a small industrial unit, and there is the seed protection unit as well, and there's a bit that does vaccines. So they do. I'm trying to think the lipid layer that sort of
the fat that goes.
Yeah,
I think about
allows you to deliver it. I'm trying to think how to explain it, but yeah. But things, because what's happened recently due to destocking, which has sort of happened across the chemical industry, has hit Croda particularly hard because they do all their manufacturing from the same plants. They have shared manufacturing plants. So most companies would have, let's say, one for each, and then if one division does badly, their utilization drops and their margins get tanked. For Croda, they're shared, and they use SAP to, work it all out, which is just mind-blowing. I mean, especially if you go and see the factory itself, it's sort of, how does SAP do it? I don't know, but anyway. But the trouble is, when you have three businesses doing badly at the same time, their utilization falls very low, and therefore their margins get really, really hurt. So we were sort of able to look at this and go, okay, this is a business that's massively under earning. We know what it should be doing, and we just need a little bit of growth to come back. And we've started to see growth coming back with agricultural, because ag cycles can turn quite quickly, and maybe that will be enough to sort of get margins back sooner than expected. But if not, they'll even if it takes sort of 1 to 2.5 years for margins to get back, we then own a great business at a pretty attractive valuation based on that.
And I think one of the work that Aubrey and the team have done that I found really remarkable when we looked at this, and then we've looked at Croda many times in the past, it never got to the price that we want to buy that. And I think the opportunity now is that they've got this short-term issue that's causing it to be hated by the market. But if you look under the hood, what you have basically is this. When we were able to strip the numbers out, you've got this extremely stable personal care business, like what you would expect from a Unilever or a Procter & Gamble. Super stable. It's almost like a bond, and that's just growing steadily year after year after year, and it's just doing extremely well. And then there's a layer on top of it that is more kind of cyclical in nature, where they still earn higher returns on capital. So it's more of a high quality cyclical kind of layer on top, and that adds volatility to their revenues and earnings. But underneath it is just this really stable business that deserves a very high multiple. And the way we think about it is, well, when you buy Croda stock, you're buying this very stable business that deserves a very high multiple, and then you're getting this cyclical business that's still a higher quality but deserves a lower multiple. And it's now trading as if the whole thing is cyclical, which is not actually economically right. And I think kind of this is what the market is missing, I think, now. And once you get this kind of cloud that's covering the earnings away, the true potential of this company will shine. And so we're very excited about it. And this is the sort of thing where I think, I'm not going to say we're unique, but we're rare in terms of market participants in our ability to look at something and think, okay, forget about the next 6 months or 1 year. Frankly, we have no idea when this thing is going to recover, but we have a high degree of certainty that 3 to 5 years from now, they're going to be earning a lot more money. And we're willing to look beyond kind of the next few months or year. And it's kind of like a time horizon arbitrage, I think, is how we think about it, where the average market participant is thinking 6 months, and when we're thinking 3 to 5 years, and that gives us that patience is rewarded with opportunities like this one.
Which is absolutely key to what you do, isn't it? And part of the process and philosophy
Absolutely.
and the mindset.
Arguably, it's the key, because I don't know if that we're smarter than other people or faster than other people. Maybe we're more attractive than other people. That I'd like to think that, but I don't think that matters in terms of investing performance. But I think it's that patience component that gives us an advantage.
Well, gents, thank you so much. We've absolutely cantered through those questions, and thank you very much for answering them so thoroughly. I would like to also thank our audience for joining us today and for their questions once again. If you do think of a question post this session, then please do let the investor relations team know. We'll be happy to answer those independently. But other than that, I would like to draw today's session to a close. And thank you all so much, and have a good day wherever you are. Thank you.
I'd like to get one more comment, if that's okay.
Oh, sure.
Yes. So today, inadvertently, because Aubrey's not feeling well, we ended up trying a different format where we're going back to something we did many years ago, which is each one of us is on a separate camera. So if you could just give feedback to Lee and her team about how you think about this format, we had to do it this time, but if you find it better, or if it flows better or looks better or whatever it is, or if you hate it for that matter, just please give us feedback so we can learn from it.
Well, with that, I would like to draw the session to a close.
Right.
And thank you so much, and have a good day wherever you are.
Thank you.
Thank you. Take care.
Thank you.